podcast. This is Ron Costa broadcasting live in the Mappable USA studios in Las Vegas. And we have another great show coming up for you guys right now. We've been talking real estate crowdfunding over and over again, and that means we talk opportunity zones, and that means we bring in Vicki Hutchmala from the QOZ Marketplace. Vicki, are you there today?
I'm here, Ron. Another exciting cold and cloudy day in Vegas, which is relatively unusual, but nevertheless, we have another exciting guest with us today to talk about opportunity zones.
Yeah, I'm really psyched about this one, Vicki, because a lot of people know from our previous podcast that to invest in opportunity zones, you really got to look at these funds out there. What funds are out there? And there's a ton of them. There's a ton of funds that develop every single day. And today we're really happy to bring on Brett Messing from Skybridge. Brett is the president and chief operating officer there. Brett, are you there today?
I am. Thanks for having me. I appreciate it.
I'm really happy that you took the time to join us on the podcast today. You guys have just a monster fund that you're working on right now, and I thought maybe we would start by going over your background and how you found out about opportunity zones, and what you think about what's going on with them.
Sure. Well, my background is I actually grew up in Rhode Island. I went to Brown and Harvard Law School. Then I spent most of my early career working for Goldman Sachs. And then I had my own hedge fund for about 8 years. And then thereafter, I actually worked as deputy mayor of Los Angeles. I lived in L.A. for 25 years. And that was interesting because I got to see how a number of the existing tools work, and essentially their limitations in terms of driving capital into areas that would benefit from capital. Thereafter, I taught at UCLA, and then I got divorced, and my kids went to college, and I ended up moving to New York, and now I'm the president and CEO of Skybridge.
What a road to success!
Yeah, no, there are a few turns in it, but it's been a fun ride, and hopefully it'll keep going that way. But you asked a question about how we ended up in the opportunity zones. Skybridge is a $10 billion fund of fund, and we'd like to sort of become an asset manager. In other words, have a variety of different products. And this was our first new product initiative, and it was particularly appealing to me given sort of the social impact aspect of it. Having worked in city government, but I think more importantly, because in this context, we're accidental do-gooders, right? We are capitalists. We're trying to make money for our investors, and we're grateful that we can have a positive social impact while doing that. But what I think is really interesting here, and people don't really talk about it as much, is the opportunity zone really offers. It's a tool to reduce risk in portfolios, and essentially, the government is subsidizing you to de-risk a portfolio. So if you have a concentrated stock position, so let's say you invested in Amazon 8 years ago, and now Amazon represents 70% of your stock portfolio, rather than selling the stock and paying substantial capital gains on a federal and a state level, you can roll that into an opportunity zone and realize the tax benefits that I imagine your listeners are familiar with, and so I think it just has broad utility for investors in reviewing the amount of risk in their portfolio they have.
Well, I think that's the jewel that's contained within the Tax and Jobs Act that the President signed in 2017 rather. That it allows the opportunity for folks to take advantage of a tax deferment, at the same time making it something that you can actively participate in the community and elevate people's quality of life. So you get that great pull at your heartstrings feeling, while at the same time you get to invest and turn a profit.
Yeah, no. If you take a look, sort of socially responsible investing, or ESG, is sort of one of the fastest growing sectors. And there are a couple parts of this law that I particularly like in terms of how it's structured. So, as you're aware, there are three tax benefits, right? One is deferral. So if you have a realized capital gain, you can defer the payment of the tax liability until 2027. You can also, if you invest this year, that deferred liability is reduced by 15%. But by far the biggest tax benefit, right, is that an investment in an opportunity zone, if held 10 years, is tax-free from a capital gains standpoint. You pay no capital gains. And if you assign math values to those three benefits, the deferral, the reduction, and the exclusion of the capital gain, the third one being tax-free, the third one is where all the action is. That is by far bigger than the other two. But that is dependent upon the creation of a gain, right? So I would compare and contrast this with there were tax shelters in the 80s where there was so much, accelerated depreciation and write-offs that you were winning the minute you made the investment. And so you didn't really care where the capital went. So what happened was, bad real estate investments, minerals, movies, all kinds of stuff. And you can draw a dotted line from that to the savings and loan crisis. This particular law, the way it works is it acts as an amplifier, right? So it doesn't make a bad investment a good investment. It makes, a fair investment a good investment a great investment, and a great investment an awesome investment. But you have to, again, it sounds simplistic, you have to make money, and I think that will result in much more sort of prudent allocation of capital.
Well, right, and it allows investors to invest in the opportunity zones that they wouldn't relatively look at in the first place, but it helps them to go there and still accomplish their goals of, rate of return for their investment.
Yep, no, absolutely. This, look, if you apply sort of the math of this, this turns like a 6% return into a 10% return, or an 8% return into a 14%. It's very material, the impact it has, again, in terms of amplifying returns.
Right. We know that Skybridge holds their funds in Opportunity Zone Fund as a real estate investment trust. Why did Skybridge choose that entity to hold the funds, and how do real estate investment trusts work better with Opportunity Zone funds?
There are a couple reasons for why we went with the REIT structure. I would generally say I'm structurally agnostic. There was a lot of early debate around what structure is best, and I'm a zealot about the program, but I'll explain why we went with the structure that we did. But I think that there are other structures that have virtues as well. But for our investor base hates K1s, right? So if you have a partnership structure, your investors get K1s. They have to do in a partnership structure, they have to do state tax filings. So by being a REIT, there's no K1s, there's no state tax filings. When the properties start cash flowing, because as you know, the Opportunity Zone investments have to be development or redevelopment. So in most cases we're buying a piece of land and we're building something, whether it be an apartment building or a hotel. So it's going to take a few years before that asset starts generating cash. But once the portfolio starts cash flowing, as a REIT, we have to pay out 90% of the income to our investors in the form of a dividend. And investors like receiving those kind of distributions and knowing that it's sort of mandatory, right, that we spit out the cash, if you will. So that on the front end, or that is an important reason. In terms of exiting, the REIT provides a potential path to an IPO, which if we could ultimately take our REIT public, that would be a great way for our investors to sort of realize their appreciation and their non-taxable gains on the back end. And then there are also, without getting too sort of geeky and technical, in terms of if we end up doing individual asset sales, there are some virtues that the REIT has over the partnership structure in terms of just exit mechanics.
Right. So you did your major due diligence ahead of time before you decided how you were going to go about structuring it, which I've learned in all of the podcasts and in the people that we've talked to that the primary thing involving real estate in opportunity zones and having opportunity zone funds is you have to deal with the details before you even start to think of creating a fund, because without the details ahead and set up and all the information into the decision making, you kind of are cutting off your nose to spite your face. So the details are what are important in getting this done, which is as you just explained, why you decided to do a REIT instead.
Yeah, no, I think, what I tell people is there's sort of two critical missions here. One of the missions is, right, as I said before, you have to make money, right, because the benefit of not paying taxes on a gain isn't worth anything to you if you don't generate a gain. But the second sort of critical mission is you got to preserve the tax benefit, and so there's a significant compliance aspect here. There's some complicated rules involved. I mean, this isn't like putting man on the moon kind of complicated, but it is complex, and I do think that you will see, articles down the road about, certain developers who, saw opportunity zones as a way to make money, and they just didn't have the infrastructure to ensure the compliance, and as a consequence, the tax benefits were lost.
I guarantee you're going to see that. I guarantee it. There's no question in my mind, unfortunately, but that's a great point. And another thing I wanted to mention on this, like you said, Brett, is if you're investing in a opportunity zone, or let's say in a Skybridge REIT, and you keep your money there for 10 years, the REIT is worth X amount of dollars on day one, and then in 10 years it's worth Y amount. That difference between the X and Y is a profit. You're saying that there's no capital gains taxes on that whatsoever for the investor. Is that right?
Yep, no capital gains taxes on that. So it's incredibly powerful that way. That is certainly the most powerful reason why you would be looking to invest in one of these funds. But as you said earlier, too, you're not really looking to just throw money away on a bad deal. So choosing the fund and the developer and the experience is really important. That's something that all the investors really have to look into. No, I think that's right. Look, I think at the end of the day, opportunity zones aren't going to be any different than any other asset class, whether they be hedge fund managers, hedge funds, venture capital funds, private equity funds, any kind of mutual fund, in that a third of them are going to sort of suck, a third of them are going to be okay, and a third will be good to great, right? At the end of the day, you have human beings. You're going to have sort of like the normal dispersion of results that you get when you have any cohort of human beings. And I don't think, look, at the end of the day, there is complexity here. But, one of the things I joke about is that, the oldest profession of all time is prostitution. I think, construction is probably the second oldest, right? You had two people living in a cave and they said, let's go build something out there. And all this really is, right, is it's construction with a tax overlay, right? So it's complicated, and real estate is hard, but it's not that complicated.
Yeah, and that's why it's important to partner with somebody who knows what they're doing, which obviously Skybridge does.
Well, that's kind of you to say. We think we do, and we're certainly dedicating the resources to make sure that we execute for our investors.
What kind of asset classes do you guys like? Is it multifamily? Did you just basic development from the ground up, or what's your specialty? What's the sweet spot for you guys? What kind of properties do you like?
Well, let me answer that question first on a regional basis, right? So, like in terms of what places. We primarily like urban areas, and I think that most of the capital is going to go into cities and not into the rural areas, because when you make it a real estate investment, the number one variable that correlates to real estate appreciation is population growth. So where are the people moving? And urbanization it's not just a U.S. phenomenon; it's a global phenomenon. So people are moving to the cities. So we're going to be primarily in cities, and we're looking for cities that have sort of population growth, economic growth, right, job creation, business-friendly climate, affordability, which usually means, low state taxes, and more business-friendly climate. So, where does that put us? So if you apply those criteria across the country, you're talking about Southeast, down through Texas, right, up Phoenix, Vegas, Salt Lake, Denver, into Portland, exclusive of my beloved California, which is just sort of too expensive. So I'd say those are, so think Charlotte, Jacksonville, New Orleans, again, the cities that I mentioned. In terms of the specific types of assets, I think apartment buildings, multifamily will be the largest. Industrial will be the second. We all have, Amazon Prime, and we want them to deliver our stuff within 2 days. And it takes a lot of sort of infrastructure and logistical support, warehouses, things like that. And the Panama Canal widening has created a lot of demand for additional sort of industrial property up and down the East Coast. And then lastly, hotels. In fact, our first deal is a hotel that we're building in New Orleans. And the thing about hotels is hotels actually create a lot of jobs, right? You have to think about this in the context of the goal of the public policy, right? It's job growth, community redevelopment.
Mm-hmm.
When you build an apartment building, and that will be, we'll build more apartment buildings probably than anything else. They don't create that many jobs, right? You got a manager, a custodian, a few other people maybe. Hotel, you're going to have 150 jobs. In many cases, a lot of union jobs. So hotels are.
Yeah, this is the hotel capital of the world. We know all about jobs in hotels.
That's right.
You certainly do.
Yeah, and that's what that second round of guidelines really kind of targeted. I think with the whole business aspect of opportunity zones, because I think if the opportunity zones program in general is going to be successful, it's really going to hinge on the creation of jobs, because that's what's going to keep people there and avoid gentrification and issues like that, I think.
I agree. I'm just to make for good content, I'm going to slightly disagree. So I agree in principle, but so these tax benefits are available, right, if you invest in either real estate in opportunity zones, right, the geographical areas, the 8,700 census tracts, or if you are sort of financing a business, or a startup business. And I don't think that much capital is going to go into the business side. For the following reasons. And you're right, the last set of regs, Treasury's trying to make it easier. They're trying to make it more accommodating of capital to invest in opportunity zones for business formation. But the question of where a business exists is sort of an existential one, right? So with real estate, right, we build an apartment building in an opportunity zone in Oakland, right? We know where the building is. It's in the zone. The jobs are in the zone. Easy. With a business, okay, so what if the business is, let's say, incorporated in Delaware, its headquarters are in Oakland, most of the jobs are in Salt Lake, most of the sales are in Manhattan. Like, where does it exist? And, it's hard enough to grow a successful business without having to comply with, the various rules that are imposed on you to preserve the tax benefits from the Opportunity Zone program. So I think there's going to be I think businesses are going to benefit. Look, when we build an apartment in an opportunity zone, we need to know that there is sufficient, earning power so that people can move into our apartment units and pay the rent, right? So there will be a indirect correlation between real estate and business growth. I think that when the program ultimately expires in the end of 26, that if we look at the distribution of capital that went, again, directly into dedicated opportunity zone real estate funds versus, let's say, dedicated opportunity zone business funds, it's the vast preponderance is going to be in the real estate funds. But I've been wrong. I've been wrong before, but that's just that's my perspective on it for what it's worth.
And as you mentioned too, there's a lot of specifics involved in that too. I think there's some of that 90% rule, and there's that the timing on all these developments. So yeah, I can see where you're coming from on that for sure. But getting back to your fund for a second here, what I really like about this is your plan about the dividends and investors coming in once this thing starts getting profitable and spurning off dividends. I think that's something that investors would really like. Do you think that's one of the big draws on your project, or are other projects doing something similar?
What the REIT sort of offers is sort of it makes the distribution of the cash flow mandatory, right?
Yes.
And I think investors like that. I think people that do partnerships will probably also make distributions. They're just not sort of legally required to. So I think it's helpful. I think the bigger selling point, again, is sort of the administrative ease, actually. In our fund-to-fund business, it's structured as a registered investment company. So as a consequence, our investors don't get K-1s, and it makes a huge difference. If we had K-1s on our fund-to-fund, which again is a $10 billion business, the business would be 30%. It'd be 70% smaller. So I, at least amongst sort of the more retail investors, that kind of thing makes a difference, because they're just not set up with the kind of sort of accounting infrastructure to deal with filing state taxes in Arizona and Texas and Alabama, you know what I mean, and all that other kind of nonsense.
Yeah, and that's important because if you don't consider that, then you could be up a creek.
Yeah. Or you end up for what your investment is, you may end up incurring substantially higher accounting fees than you expected, and then you won't be happy about that. So
exactly. Are you finding that there's a lot of participation at the local municipality area where the opportunity zones are in terms of getting your projects approved and getting the permitting process quicker? I know that in Nevada, and especially here in Las Vegas, that the municipalities are streamlining that process to make it easier to go into the opportunity zones and start construction quicker because of all the time constraints. Are you finding that across your various projects?
So that's an excellent question, an excellent point. So again, back to the way the law and the opportunity is structured, right? It creates a competition for capital, right? So investors can go to any one of these 8,700 zones. So the zones have to compete with each other. So rural Oklahoma has to compete with Charleston, South Carolina. Or more to the point, Stockton, California has to compete with Charleston, North Carolina. And what I've said before is just because you make a city with sort of let's say it's in a tough place, like I don't know if you've been to Stockton or Pittsfield, Massachusetts, like these are cities that just have real challenges. If you make that an op zone, it doesn't make it an investable area. So as a first cut, certain cities will benefit and others won't. But then when you move into, okay, well, we have a category of cities that have substantially similar growth profiles, let's say, and they're similar in terms of how attractive they are, then this stuff really matters in terms of what you just raised, which is how user-friendly is the city in terms of helping you get your project done. Again, as you said, back to you have to meet certain timelines, and there probably will be some correlation between how user-friendly they are with you and how user-friendly they are in terms of just general business development in their city. And again, as someone building real estate, we need people who have jobs and can either stay at our apartments or go to our hotels, whatever it may be.
Right. Well, I know that in North Las Vegas, which is its own municipality here in Las Vegas, they have streamlined their permitting process and their construction whole planning process to 1 day. So you can go in and say, this is what I'm doing, and they will process the entire project so you can start construction the next day. I mean, that's kind of unheard of phenomenally.
No, that's remarkable. I mean,
that's
you're
completely
right. Remarkable.
Right, which helps the people and, as you said, the competition between this city and that city when the data points are relatively equal. That's another major consideration. How long is it going to take me to start?
No, look, I think that's right. And, in certain places like Los Angeles, Mayor Garcetti has really embraced the program. But, building in L.A. is very hard. And I think that, there are a good number of op zones in L.A. There are a good number of them in New York City as well. These are very challenging places to do business from a real estate standpoint. And I think they're going to suffer because of that. I think people are going to be inclined to go to cities what North Las Vegas is doing is incredible. But even where cities can't achieve that kind of speed, if they're just, again, doing much better than New York and LA, which candidly isn't that hard, they're going to benefit substantially more.
Well, and aside from just the construction aspect, that even our North Las Vegas and Henderson here in Vegas are also offering local tax incentives regarding opportunity zones and getting in there, as well as setting up special financing with banks so that the whole process becomes more streamlined and easier to do business in the opportunity zone as well as in the municipality.
I think I may nominate you to be president of the Chamber of Commerce.
Well, okay.
The United States is a big place, Vicki. You have a lot of of opportunities there.
Well,
just be careful because if you run, I understand that Joe Biden may come and hug you. I hear that happens in Nevada.
I might reconsider then.
Okay.
So I know that there's pending legislation going into a different place. There's pending legislation in order to extend opportunity zones beyond the limit that they now have. And I'm wondering, what do you think about that? And will Skybridge do any kind of lobbying to make that happen, or does it matter to you?
No, sure. Look, we want the program to be successful. We would like we'd like to see that law pass, but we are not going to participate as lobbyists. Our job is to manage and invest capital, and I think it's our investors like to know that day in and day out that's what we're focused on. So I guess we're going to be a free rider here. We will let other people spearhead the lobbying and hopefully be successful and share in the benefits of their efforts. So we're going to stand on the sidelines and applaud, but probably not do much more than that.
Well, but do you agree that that's a good thing? Or
I do. Oh no, I 100% agree. I'm just saying we're not going to act in any kind of an advocacy position to facilitate that getting passed. But 100%. We'd love to see it happen.
All right. And let's see.
We'd like to see that too, for sure. No question about that. A couple other things, Brett. Right now, if we have investors who are listening to this podcast right now and they want to get a hold of you or find out more information on Skybridge, I know we have a listing on QOZmarketplace.com for you guys on our fund list. But how would they get in touch with you? Is a website, phone number?
Yeah, we have a website. It's SOZ REIT, REIT. So SOZREIT.com, and there's information about our fund there. You can reach out to us via email, and we'll get back promptly. And thank you for offering that up. I'm happy to. But on this. The idea of extending the law, just one other thing, I don't know if you were aware, it didn't get passed, but I think it was interesting and important, which is there was a bill introduced at the end of last year to make the areas in California, Florida, and South Carolina that were sort of disaster areas, in the case of California after the wildfires, right, in case of the Florida and South Carolina after the storms, to have those areas designated as opportunity zones. And the law actually wasn't as thought out as it probably should have been, because op zones are drawn by census tracts, and they were looking to have it applied to municipalities. And there was a lot of interest in the law, and it eventually didn't pass. But I think it does show that there might be more to do with this program going forward.
Interesting. Yeah, well, Brett, I'm a New York Mets baseball fan, and I heard there was something out there that was going to declare Citi Field a disaster area because of the way the Mets are playing these days.
Well, my partner Anthony Scaramucci owns like a teeny tiny piece of the Mets, so we have a box there. I'm a Red Sox fan, and
man,
I love
great
baseball, but I don't love watching bad baseball, so I don't make it out to our box that much. But I'm my condolences for your fandom.
What is Anthony Scaramucci's role in this right now?
Well, Anthony's a managing partner of Skybridge, and he certainly led the effort on SALT. I mean, he sort of runs the firm, and so I'm sort of spearheading the op zone. But I was just talking to Anthony before we got on the phone. Told him I was doing a podcast.
That's great. Excellent. Well, like we talked about earlier in the podcast, it's all about good leadership. It sounds like you guys at Skybridge have it all covered, and we're really happy to have known you and met you over at the Opportunity Zone Expo, and we like everything that you're doing. So you guys are doing great, Brad. Really like what's happening with you guys.
Well, that's very kind of you to say, and I want to see the program be successful. I appreciate what you guys are doing to sort of educate and advance that, and hopefully we all sort of win together on this one.
We only have the very best people as guests on our podcast,
How'd I get on then? You're lowering your standards for me. I appreciate that.
All right. Well, Vicki, do you have any closing remarks? Any other questions before we sign off on this episode?
Well, I was going to ask you about blockchain, but maybe I'll save that to our follow-up podcast.
Okay. Well,
that's good because I'll have to listen to that podcast because I don't know anything about blockchain.
Oh, well, then I won't ask the question.
Good.
but
anyway, I learned long ago to say I don't know when I don't know the answer, and it wouldn't make for very good podcasting as I keep saying I don't know.
That's excellent. Okay, well, listen, folks, everyone out there listening, you're listening to the Mappable USA podcast with we have our guest Brett Messing today from Skybridge, throwing out all this great information. I hope you guys enjoyed it. Brett, thank you so much for being a guest on the show. We really appreciate you taking some time out. I know you're really busy these days, so we thank you for that. And everybody out there listening, if you want to go to our website, mappableusa.com, there's a whole list of syndication sources out there. Pick the one that you like the best so you never miss another episode. And if you'd like to be a guest on the show, just like Brett was today, there's a guest tab there. Fill out the form, and we'll see about getting you on as a guest. So thank you all for listening so much. We appreciate your time. Thanks, and we'll be back at you next time with another Mappable USA podcast where we put you on the map. Have a great week, everyone.